Tech stocks are taking a beating, with the Nasdaq QQQ ETF almost into correction territory, down 9.7% from its July peak, and some of the market darlings in a bear market. Tesla down 15% since July, Nvidia crashing 21%, and Alphabet 22% from its peak. But one analyst at Goldman Sachs says it could be the setup before a magic moment for tech stocks, two factors converging that power tech stocks and the market higher. At the Goldman Sachs Communacopia and Technology Conference last week, tech analyst Kash Rangan pointed to the two factors that will do this: a steady lowering of interest rates and a burst of innovation to boost earnings beyond 20%. Rangan called this the magic formula that could send tech stocks higher over the next year, and because that tech makes up more than 30% of the major stock market index, when tech goes up, the market will too. I'll detail the forces behind those two factors, how likely they are over the next year, and the stocks you should buy ahead of that magic moment. But first, if you're tired of long, drawn-out security reviews slowing down your deals, and I know you are because it's a common pain point for businesses, just steps away from closing that deal, the last thing you want is for it to stall due to an endless security questionnaires. Now there is a solution. That's where Vanta comes in. Vanta automates up to 90% of the work for security and privacy frameworks, helping businesses like yours get compliant for less than the cost of manual processes. With Vanta questionnaire automation, your go-to-market teams can complete security reviews up to 5 times faster. So whether your business is a startup, in the mid-market, or at an enterprise level, Vanta can simplify security and compliance reviews to do all the heavy lifting. Over 8,000 companies, including ZoomInfo and Smart Recruiters, trust Vanta to streamline their processes, reduce stress, and close deals faster than ever. Don't let security reviews hold you back. Vanta's got you covered. So I want to thank today's sponsor, Vanta, and if you're ready to see it in action, experience Vanta's questionnaire automation with a self-guided product tour. Just click the link I'll leave in the description below. Back to that magic moment for tech stocks, and this comes down to those two factors that could spur that breakaway growth. First, lower interest rates are here, with the Fed's 0.5% cut at its meeting on the 18th. Now, that surprised the market, with some expecting still only 0.25 point, so it seems the Fed is going aggressive here to head off any economic weakness. And beyond that initial cut, we should see several more over the next year. That's because determining interest rates comes down to the Fed's two mandates or rules: low unemployment and stable prices. After spiking to above 5.5% in February 2022, the Personal Consumption Expenditures Report, PCE, on inflation has fallen closer to that Fed's 2% target. Unemployment, though, has increased, up 0.5% from January's 3.7% to 4.2% in August, and triggering what's known as the SAM rule that has predicted recessions in the past. So because of this, lower inflation but higher unemployment, the CME FedWatch tool, a futures-priced tool showing the market expectations of Fed rate hikes or cuts, shows the market now expects the central bank to cut rates by a full 2.5% through September of next year. A 2.5% cut to rates, almost halving the federal funds rate, would be a huge move. It's not just lowering the borrowing rates for consumers. Those rate cuts are positive for expansion planning by tech companies because those debt costs fall, multiple expansion increases along with valuations, and those deals can get done. It's that previous 5.5% rate before the cut was the highest in the G10. The U.S. has actually seen more moderation in its inflation, so there's little reason why the Fed can't aggressively cut rates and spur this magic factor for stocks. Now, as for earnings growth, the second factor there, Rangan must be looking at a different subset of tech when he quotes growth rates of 11% for the industry, because FactSet data shows us tech companies in the S&P 500 grew their earnings by 20% in the most recent quarter. On top of that, net profit margins, that's the bottom line profitability, was 25% in tech stocks during the first quarter, the second highest among stock sectors, and above the 23% margin reported last year. That means companies in the tech space are getting more profitable. Looking ahead, tech companies saw the highest change in expectations for next year's earnings as second quarter results were coming out. This chart shows the change in analyst expectations for those earnings in the stocks in this sector. While companies in the industrials and energy sector got downgraded, Wall Street expects tech companies to make almost 2% more than prior expectations, leading to forecasts for earnings to accelerate to 21% through that next year for the second strongest profit growth of 11 sectors. And then beyond this already strong earnings growth, companies are already starting to see those initial stages of that boom in AI-driven productivity that Rangan is talking about for this factor. David Sandstrom, marketing chief of payments firm Klarna, reported last month a decrease of 25% in its external marketing spend over the last 3 months, the equivalent of saving $10 million a year just by using generative AI tools. So we are getting those lower rates and that earnings growth, and the compound of the two, according to Rangan, is when the magic starts to happen for stocks. While AI will eventually drive productivity growth for the broader economy, it's the software companies like Salesforce, ticker CRM, could be the next wave to benefit. We have started to see this already, but it's mostly been on that hope for stronger sales growth, with investors still waiting for those sales to materialize. The semiconductor hardware space has already seen this in its first wave, with NVIDIA's 125% boom in revenue this year. Salesforce is the largest provider of customer relationship management software, with $35 billion in full-year revenue. Now, granted, it takes a lot to boost shares of a mega-cap company like this, but Salesforce has the scale and the financial power to develop those AI models and the trust of its customers to deploy them. Shares here plunged more than 20% in May when the company gave a downbeat forecast for its second quarter and full-year financials. Now, while revenue was up 11% from the year prior, CEO Benioff pointed to higher spending on the AI that could slow earnings growth over the next year. As a result, that stock is down 22% from its February high, but could be about to get that boost from those AI efforts. Benioff told reporters in August that the company was on the cusp of releasing AI-powered digital agents to help businesses automate their customer service. The company's Einstein Copilot assistant is built off more than a decade of AI development, and if it can do for customer service even close to what those savings we saw in marketing with Klarna, it would be a breakthrough. Shares of CRM are trading for just 6.6 times on a price-to-sales basis after that weakness this year. That's against a valuation as high as 8 times just at the beginning of the year. Strong growth on its developing AI products and low valuation make this one to watch in the theme. While chipmaker Advanced Micro Devices, ticker AMD, hasn't seen its shares rocket up like pure NVIDIA, the stock is up 42% in the last year. That build-out of infrastructure for artificial intelligence, so the semiconductor chips, which are like the brains of any electronic device, that's not over yet. AMD CEO Lisa Su was at the same conference talking about the AI supercycle and a $400 billion market by 2027. Su was there to talk up AMD's pipeline of chips, including its recently released M1300 series that boasts up to 192 gigabyte memories with 153 billion transistors, enough to compete with NVIDIA in chips to train AI models. The rollout of that chip has seen the fastest product growth in the company's history and could amplify already strong growth forecasts of 28% in the next year on revenue. If it does, it could make AMD a steal at this point. Shares are already a value play, trading at just 9.7 times on a price-to-sales basis. That's nearly 3 times cheaper than the 27 times valuation investors are paying for shares of NVIDIA. And with the continued market growth for chips, AMD is sure to capture a piece of that market. I highlighted this next stock as one of my top 10 for 10x returns, 10 stocks I've invested more than $500,000 in, and am planning on holding for the next decade. Check out that video next and see the full list of stocks. Back into the software side of AI, and one of my favorite AI stocks right now is SoundHound AI, ticker SOUN. I recently highlighted SoundHound as the 4th biggest holding in my own portfolio. At a $1.6 billion market cap, we're talking a very small company, but the leader in conversational AI that can build assistants in 25 languages, and could be a market of $160 billion according to management estimates. The company is booking sales growth of 80% a year, but even a fraction of that $160 billion market would mean outsized growth for years. The company got a vote of confidence in February when it was reported NVIDIA invested $3.7 million into SoundHound and was providing hardware to the company. The shares popped another 50% on a single day in July when it was reported the company's voice assistants would be used across Alfa Romeo and Citroën vehicles in Europe. Now, as a much smaller company, shares are going to be riskier here, bouncing up and down, but I like that long term as SoundHound proves itself in that voice assistant market. Your business cannot afford to miss deals because of security reviews. Experience Vanta's questionnaire automation with a product tour. Just look for the link in the description below. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.